Welcome back. And to kick off this afternoon, we are pleased to welcome staff from the SEC's Office of the Advocate for Small Business Capital Formation. Jenny Riegel, Deputy Director of Policy, is going to provide an overview of the office's fiscal year 2025 staff report. This is one of my favorites, I know. So which includes an in-depth data on the state of capital raising activity across the country. And I think we'll find the data and information that Jenny shares will be particularly relevant for our ongoing discussion of the ways to support small businesses and as context for our understanding of the public and the private market trends. So I'm going to have you take it away, Jenny.
Awesome. Thank you so much, Marcia and the full committee for having me. I'm thrilled to be here. I'm going to share my screen, which will have slides of some of the data that I want to highlight here for the committee from the staff report. So you can find a full copy of the report on www.sec.gov/OASB. So for those that want to follow along in the online copy, I'll share page numbers of where the data is located. So without further ado, we'll dive on in. So the report is organized by life cycle. So there's a life cycle chart shown on page 3 of the report, and it has the 3 life cycles. So it's going to be small and emerging companies, which are companies that are just getting started, as well as companies that have been received angel financing or seed financing. And then we're going to turn to mature and later stage companies. And these are companies that are often VC backed. And we're going to look at the VCs and investors that are backing these companies, as well as the final life cycle that we're going to look at are IPOs and small public companies. So with that, let's go ahead and get started. So starting on page 4, we see that capital access remains a primary concern for small businesses, with 48% of entrepreneurs stating that they would start a business if they had more money. We turn to page 6, we see that similar to prior years, less than half of small and emerging businesses turn to external financing. So of that 38% in the blue circle that do, we see that only 6% seek a friends and family loan and only 4% seek venture capital. So stepping back, this is a key point for our office and this committee to keep in mind. So while investment capital is, of course, a very important part of what we focus on here at the SEC and what this committee focuses on, it is not for every business. So now let's turn to pages 9 through 11. So this area has lots of data on the important role of entrepreneurial support organizations and angel investors. So this slide has the data on entrepreneurial support organizations, and these are incubators and accelerators, and they play a significant role in the development, mentoring, and funding of early stage companies. In addition, we're going to turn to page 11, and we see that angel investors are a vital component in creating the next generation of startups, funding over 55,000 businesses in 2024. So we're going to turn to page 12 now and take a look at seed funding. So mirroring the overall market trends, we see that seed deals increased in size. However, when you're looking at the overall VC market, we saw that the share of pre-seed and seed deals declined, and that data is on page 13. So next, I want to take a step back and look at some SEC data and highlight some context on how companies are raising capital versus how pooled funds are raising capital. So for companies, in the purple circle, you see that traditional private placement exemption under Rule 506B is raising a significant amount of capital. The other exempt offerings are offshore offerings under Reg S or Rule 144A offerings to qualified institutional buyers. And those continue to raise the largest amount of capital that companies are raising. So turning now to pooled funds. So these blue circles show that the vast majority of capital is raised under Rule 506B of Regulation D. Again, that's your traditional private placement exemption. So turning to page 18, that has the Regulation D data. And here I wanted to show the comparison between what operating companies are raising, that's the mustard color in the bottom, of the bar versus pooled funds, which is the gray color at the top. And you can see that the amounts, the number of offerings are fairly similar, but the amounts have a significant distinction between pooled funds and companies. So next, I'm going to turn to mature and later stage businesses. So this starts on page 33 of the report. And we see that VC investments continue to shift, and this is something we talked about with the seed capital, from those earlier stages toward later stage VC investments, and that's the green is the later stage. We also saw that as deal sizes grew, deals became more concentrated, and that concentration is really illustrated in this stat to me. In the first 7 months of 2025, roughly 40% of all VC dollars went to 10 companies. So if we turn to page 38, we're focusing now on funds and what's happening for those pooled funds. And we are seeing a shift of capital toward larger and experienced managers. But beyond just the amounts, we're also seeing that for the first time in a decade, emerging managers closed fewer funds than experienced managers. So looking at the number of offerings. So now turning to IPOs and small public companies. So on page 47 of the report, it starts with IPO data. And before we get to the data on the slide, I wanted to note something that Chairman Atkins actually noted in his remarks, that the number of IPOs has remained historically low. But we are seeing also that over the last 3 years that number has trended upward. And now this graph, which is on page 48, breaks down IPOs into the number of into offered IPOs by smaller public companies, which are companies with up to a 250 million market cap, IPOs by larger companies, and then your SPAC offerings. And we see from the data that in 2024, IPOs by small companies represented 44% of all IPOs by count, but only 3% of the capital raised. On page 49, we see that the data seeks to provide insights on the types of companies that are going public. So we see that companies that go public are more likely to have higher sales, higher capital expenditures and assets, and less profitability. Now on page 52, we see that while public companies represented 44% of all public companies, they were much less likely to be exchange listed than larger public companies, and that's that 32% versus the 2%. We also saw on page 55 that small public companies are less likely to receive analyst coverage. So there's 2 additional sections I wanted to highlight in the report before I turn it over to you for questions. Is on page 55, the report summarizes the office's outreach and engagements from the year, as well as their educational resources. And saving the best for last, on page 52 or 72, the report summarizes the activities of your committee. Thank you so much for your service, and I welcome your questions.
Wow, Jenny, that was great. I think we could sit here and dissect a lot of the stuff that's in that report all day. Wow, 40% of VC dollars went to 10 companies. That's quite a statement. Wow. Questions specifically for Jenny? Go ahead, Robert.
I want to go to your definition of small companies at $250 million. Does the SEC have a size standard for small companies? Because we aren't, at SBA, we're not tracking one. If you do, I'd like to better understand what's being used casually, what has actually been promulgated as a rule. That's crucial to my office here.
No, it's an excellent question and one we get a lot, right? Because what is a small business changes. So in the statute that created our office and created this committee, Congress gave the definition for public companies of that 250 million market cap. So that kind of measure of, at least as a public company, is based on the statutory guidance from Congress.
All right, thank you. Do you know where in the statute that is?
I'm happy to send it to you. It's actually in the discussion of the committee. And I'm happy, it's on our website, has the statutory definition, but happy to share. Or Amy, if you have a moment, if you could share the link.
So I have the statute. I just I don't see in here that it's 250 million. So I just want to be 100% sure as we conduct oversight of the SEC. That's a crucial thing to know. Thank you.
Jasmine, you have a question?
Yeah, this is great work, by the way. I always look forward to this report because it's just got so much great data. So I was really interested that you're collecting the resources. Like it just seems like a great resource for small businesses, like all the incubators, you mentioned different funding sources. I had a couple questions on that. I guess, are there other sources you know of that kind of centralize this sort of information, like putting aside from the kind of data on the IPOs and so forth, but the actual kind of resources? What else have you guys found in your research in terms of other places businesses might look for this kinds of information? Or is this it? Is this the best thing that's out there?
Well, I certainly am not going to say we're the best thing out there. I think we seek to tell the story of capital raising and to tell what small businesses are, everything from your startup all the way through angel investing and VC-backed companies and through companies going public. And we try to include as many sources as possible. We seek feedback from people in the market. We do a lot of white paper studies. We have a data analyst on staff that helps kind of pull as many reports as possible together. All our footnotes are a ton of wealth of information on multiple market experts that share in this space. And so we really do try to highlight those voices and other market leaders that are sharing this information. So much of the data in this report is actually from third parties that we're trying to bring together that data to truly be able to share the story of capital raising. And so a lot of it is, there's lots of incredible data out there, and I would hate to name just one, but the footnotes of this report, we spent a lot of time trying to make sure that we credit the right sources and that we credit the exact page number where we get information so people can go back to those original sources and be able to dive in further.
And have you found anything that is kind of like a digital database? I don't know if you have a footnote reference, or something that is very searchable, filterable. This is very manual for people to go through a report, but something that is actually like a digital tool that lets people search for this kind of information?
I have not seen it, but if someone has seen it, please weigh in and help email smallbusiness@sec.gov. And we welcome additional kind of thoughts, and people will often share their research. And we very much appreciate that because it will help highlight kind of what is happening in the market. But I have not come across like an easily searchable database.
Okay, thank you.
So Jenny, the one slide that you showed that had the small companies that were did an IPO, I think it was like 2024. Was that when there were like 107 IPOs and it was around 2 billion? Was that 2 billion the total? So that basically those 107 companies went public for less than 20 million? Am I doing the math right?
Yes. So these are the smaller IPOs are quite small.
Quite small. Okay.
And often, there's data in the report that talks about different IPO data pieces and from different providers. And we always try to footnote kind of what they view as an IPO, because several people will do a cutoff. Are they exchange listed? Do they meet a minimum price? What contours of the offering are they including in those IPOs? We do any IPO. So any company that comes in to file, even if it was a secondary offering and it was their initial public offering to the markets, that would be included as an initial IPO. We don't put kind of an additional filter on it that other providers often do.
Got it. Thanks for that. Herbert and then Robert.
Yeah, Jenny, thanks for the great report. In scanning through it, on page 9, there's a graphic where it says companies value thought leadership and tangible support such as customer intros. Can you add a little bit more color to that? What else is in there? And then the second question is, do you guys look at venture studio models at all in the report?
Good question.
So that report was an external, so the on page 9, the 60% of entrepreneurs prioritized investors that provided thoughtful partnership and tangible support. That was a report actually out of January Ventures. So I would need to look back to their data specifically on kind of what the contours of what they considered. Unfortunately, we're not experts on all of the reports that have been cited in here. But we certainly want to, pieces that try and help tell that story of capital raising that really jumped out to us as kind of that matching of a relationship between a company and their investor and the importance of being on the same page as the company and investor. And so that's why that stat kind of spoke to us. Herbert, could you repeat your second question? My brain was going to the first one, trying to make sure I could look at the source.
In the report, you cover the traditional venture model, you cover angels. If you had a peek into the venture studio model where infrastructure and scaffolding is provided beyond capital.
I haven't seen as much data and reports that go into that, but I'm happy to kind of look with my data analyst to see kind of what more we're not covering of that story. And Herbert, I may look to you and circle back to kind of help get additional insights to make sure we're telling that piece of the story better in the future.
Thank you.
Robert?
So it's 15 U.S. Code 78 A2A1. The $250 million does not define small business. Small business is not defined in here. That number defines smaller public companies. So small business is defined only by the SBA, and then an agency can promulgate a rule in consultation with the administrator of SBA to define small business differently. I'd ask that future reports clarify, because that's a pretty big distinction. There are over 1,000 size standards right now based on industry. And so to just say small business loosely defined in a way that's incompatible with the statutes makes me very nervous, especially because I'm listed in this report.
Well, I'm happy to collaborate with you in the future and make sure that we get that appropriate clarification, making sure that we are kind of correctly telling that aspect of the story.
Thank you.
Great.
Jenny,
And
to
last question,
clarify,
Bart?
that was for the smaller public company IPOs, correct? That
Correct.
one slide was only
That-
focused on, in fact, smaller public companies per the statute?
That is correct.
But
Thank
the
you.
phrasing was small businesses. Rose.
On that slide, it's small public companies, Robert. I think your point is taken, but I don't think that there was a mischaracterization with regard to this report.
All right, Bart?
First of all, great job. This report's sort of amazing. Just a little bit of anticipation of the conversation that we're about to have. Did you notice any trends on sort of secondary transactions? Maybe provide a little context about what that means and what those type of transactions look like in terms of accessing the public markets.
So we did include some data, and I'm trying to quickly see if I can find the page reference on what we included. But we did not go into it nearly in as much depth as PitchBook I know we'll go to today, and Emily in particular. So I definitely look forward to her presentation on this, as it is a very much an evolving area of the market. Yes, I apologize. I did not have this tabbed, and I should have.
We have some discussion at page 40, Jenny.
That's correct. Thank you, Amy. So page 40 has information about exit activity, but then also talking about how the private secondary market has gained traction. So it has kind of just the start of information. So the information in the report is as of June 30. of 2025. And so we really do cut it off at that point to allow, one, reports to try to line up as much as possible. We are sometimes, unfortunately, looking at apples to oranges, but we try when we have a number of pieces of information to try to have it end at June 30, to try to compare as much as possible. And so this was kind of because the secondary market is such an evolving area of the market, it may be different than what Emily is going to present today.
Great. Jenny, thank you so much. I know how much work it is to put this report together, and the entire staff did an amazing job. So thank you so much. We really appreciate being able to see this kind of data related to small business. So thank you very, very much. All right, we're going to shift gears. Yeah, of course. So we're going to shift gears now and launch into detailed discussion on the private secondary market. And this landscape looks very different than it did 10 or even 5 years ago. Continuation funds are becoming more prevalent, and there has also been a rise in special purpose vehicles to allow LPs, VCs, and other strategic investors to find exits and rebalance their portfolios through the private markets. And additionally, startups are using private tender offers to attract and retain talent. And this is a phenomenon that was not common before. So I'm hopeful that our invited speakers today will help shed light on these newer trends, clarify what's driving them, and identify the opportunities and challenges the growth and normalization of private secondary transactions create for private issuers and investor participants of all sizes. So our first speaker on this topic is Emily Zhang, a senior research analyst with a focus on venture capital at PitchBook. As her title suggests, Emily researches venture capital with a focus on secondaries and IPOs, and her work has been featured in many prominent forums, including the OASB 2025 staff report, which we just heard about, and she's previously was a private banker at JP Morgan. So Emily, thank you so much for being here and for kicking us off on sharing some of the trends and data insights that you see in the secondary markets.
Thank you so much for that introduction, and thank you everybody for inviting me here today. And before I dive into the data, I want to say that all this data is on PitchBook in my recent 2025 annual US VC Secondary Market Watch, if you want to read further after this discussion, and always happy to chat in our question and answer session at the end. So before we really dive into the secondary data, let's really begin by setting an important foundation of what's currently happening in venture capital, because the primary and secondary market are closely correlated. So I'll do a brief spin on primary VC. So 2025 was an eventful year, to say the least. There were so many news headlines that gave us optimism that the market was reopening, but also a ton of volatility that kept us on our toes. And fundraising has been extremely constrained because LPs have experienced 4 consecutive years of negative net cash flows, as you can see in this chart here. Contributions have consistently outpaced distributions, putting pressure on allocation limit and pacing models. However, we are starting to see signs of stabilization thanks to improving exit activity and thanks to alternative liquidity channels like venture secondaries playing a larger role. And as these distributions materialize, they help restart the venture flywheel. Still, exits have a long way to go before returning to normal levels. And this is 2025 annual data where the IPO window did open, but only partially. So only 48 VC-backed companies went public last year in the US, which is barely an increase from previous post-pandemic years. And just 17 of these companies were unicorns. And simply put, that's not enough activity to support the entire VC ecosystem, especially with the context that the total value of the US venture market has more than tripled since 2020 at about $7.4 trillion as of the end of 2025. So the companies that did go public were typically aligned with policies prioritized by President Trump's administration. These are sectors like AI, aerospace, crypto, and defense that dominated activity, accounting for over 70% of IPOs outside of healthcare and life sciences. And we expect this trend to continue throughout 2026 and in the secondary market, which I'll touch a little bit more upon later. So this really means that even if exit activity increases, their benefits will likely remain uneven and benefit the select few rather than venture broadly. So with that context in mind, this brings us to the focus of my presentation today, venture secondaries. And it's really been a rapidly growing source of liquidity. And we expect that 2026 will be a pivotal year as venture secondaries evolve from proving relevance to becoming the industry standard. But first, what are venture secondaries? The simplest summary is that we have a buyer and a seller that are exchanging equity after their initial issuance. So secondaries apply to both company stakes and interest in VC funds. So there's company secondaries and fund secondaries. So the first line item here is direct secondaries, which is the term for trading company stakes, and will be the main focus of today's discussion. And there are three different types of buying company equity. So first, startups can initiate secondary sales through company-sponsored tender offers. And tender offers are like share buybacks, but are typically funded by existing investors that want to increase their allocation in the company. And this really allows the company to control how many shares are sold, which investors are buying, and also at what price. Second, buyers can purchase secondary stakes through brokers or like secondary platforms. And a third way for buying company stakes is investors that already have existing relationships. They can transact secondaries through direct sales and skip these third-party involvement, like they don't need to use brokers or platforms. So overall, startup policies on secondaries are not standardized right now, though there are often right of first refusal, also known as ROFR, and also co-sale agreements. Also, all these transaction types must be approved by the startup. So items 2 and 3 on this slide are different types of fund secondaries. So GP-led secondaries are initiated by the fund manager, and GPs typically move their positions in one or more portfolio companies from an old fund into a new continuation vehicle, also known as CVs. They can also sell just a portion of their position in what's known as a strip sale. GP-less secondaries help investors get early access to liquidity, while GPs clean up their older funds and also give them additional time to maximize returns on top startups. Even though it is a notable part of the market size for GP-led secondaries is inherently limited. Sellers need to be registered investment advisors with a larger firm that can really bear the burden of re-underwriting. Buyers are typically secondary specialists, so the buyer side is also limited. And last but not least, the third line item here is LP-led secondaries. And these are when fund stakes are sold from a current investor to a new buyer. So with that context, what is the current state of venture secondaries? The past several years legitimized venture secondaries as startups stayed private for longer and exits remained few and far between. And we estimate that $106.3 billion traded through venture secondaries in the year of 2025. And this is really significant because as you can see from this chart here, secondaries are rapidly approaching the scale of public listings and acquisitions, really solidifying their role as an essential liquidity provider. And direct secondaries propel much of this market's growth, nearly doubling since 2024. And a lot of this momentum is thanks to startups and investors across VC that are integrating secondaries into capital planning, compensation strategy, and portfolio construction. However, the market is currently concentrated and top-heavy, which ultimately limits its growth potential. So Hive is a secondary platform that reported that the top 20 startups accounted for 86.4% of secondary trading value in Q4, with the top 5 alone representing 55.6%. So incredibly top-heavy. And another example is OpenAI, who had a $6.6 billion tender offer in early October. And that alone accounted for 7.2% of the annual secondary transaction volume. So in 2026, the question is no longer whether secondaries are a dependable source for realizing returns, but whether they can really establish a durable infrastructure that benefits VC at scale rather than the elite few top companies. And a question I get often is, are venture secondaries just a temporary fix for liquidity, or are they here to stay? And I'd argue that the recent rise of venture secondaries is structural, not cyclical, and here's why. Secondaries have actually existed as long as primary VC, but they had a stigma attached to them in previous years. If you think about it from the investor's point of view, you don't really want like the founders to sell really early because you want the founders to have a lot of conviction in the company, or that was the previous rhetoric. But during the pandemic era highs, a lot of rounds were oversubscribed, so secondaries were a common tool to get access to the most highly sought after startups. And then in 2022, when the venture stalemate started after interest rates initially hiked, the secondary market was a great way for a lot of investors to double down on existing investments, often at a discount. So the fact that the secondary market has been around and widely adopted through these booms and busts and in the current state really means that secondaries are here to stay. And this is really bolstered by the recent huge adoption from many influential players in finance. In the last 3 months, Goldman Sachs acquired Investor Industry Ventures, Morgan Stanley acquired platform Equity Zen, Charles Schwab acquired platform Forge Global, and tender offer platform Nasdaq Private Market announced a partnership with investor G Squared. And these institutions are investing heavily in venture secondaries because they're finally realizing that the private markets generate so much value, and secondaries have a key growth. They have the potential to be a key growth driver for their business. So secondaries are no longer just a temporary solution to venture's liquidity problem. Instead, they are becoming a strategic asset for startups, investors, and service providers that industry participants can no longer ignore. Another question I've been hearing a lot this year, especially if you've been looking at headlines recently, is that if secondaries are so concentrated in the top companies, what happens if SpaceX, OpenAI, and Anthropic go public? And that's a really good question. It's true that one big differentiating factor about 2026 is that many of venture's most valuable companies are now actively preparing to go public. And this is a notable departure from recent years when they seem to be able to raise unlimited amounts of private dollars. And what we're really seeing now is that they're capital intensive, highly competitive sectors like AI and space technology. And the scale of investment required to win has made the public markets essential. But this creates a new challenge as well. So many of these companies are enormous, as you can see from the valuations on the screen here. If several pursue IPOs around the same time, public market capacity and investor appetite could become overwhelmed. So the short answer is yes. If all these standout companies go public, they will definitely leave a big gap in the secondary market. But I would argue that more IPO activity is overall a positive tailwind for secondaries. At the end of the day, if you're a secondary investor, you want a near-term exit. You're not like a primary investor who's willing to wait a decade or more. You're looking more at 4 to 6 years. So a pickup of IPO activity or even like anticipated IPO activity creates a positive feedback loop and also expands the pool of companies that are trading actively, as we're already starting to see, and is overall a boon for the market. So we might see a large dip in secondary volume in 2026, initially after one or all of these companies go public, but in the long term, secondaries are expected to expand. So similar to sector trends among IPOs that I discussed earlier, we expect secondary buyers to prioritize startups that are at the intersection of technological leadership and policy support. So this chart here is for primary VC, but provides important context for secondaries. So in primary VC, AI alone captured 2/3 of deal value and 40% of deal count in 2025, really cementing its dominance. And there's also higher primary valuation step-ups among AI startups relative to the non-AI peers. And this has really created significant paper gains for employees and early investors, which really has increased the incentive to pursue partial liquidity through secondaries. This positive feedback loop, it leads us to expect that secondaries will remain disproportionately concentrated in a narrow group of sectors in 2026. We're looking at AI, crypto, defense, and aerospace standing out as clear beneficiaries, similar to 2025 and similar to primary VC. And as this competition for talent intensifies, especially for AI startups, liquidity has become a crucial component for employee recruitment and retention, which is why we're starting to see so many of Venture's most valuable startups post tender offers regularly. So after all, like 62.4% of US unicorns were founded in 2016 or earlier. So that means that many of Venture's most valuable startups are for early employees and investors have been waiting over a decade for their payday. And over time, regular liquidity programs give startups greater flexibility to plan exits strategically rather around shareholders' liquidity constraints. So it's a win for startups preferring to stay private for longer, and it's a win for employees who want to buy a house or want to get married, and they're able to cash out part of their holdings. So I would be remiss to talk about venture secondaries without mentioning special purpose vehicles. So SPVs have been a controversial topic in secondaries, and the rapid adoption in 2025 really exposed growing pains. So SPVs have become so popular because they attract investors that want access to the top startups, and they provide greater speed and flexibility than traditional funds. And often SPVs are some of the only ways that investors can get exposure to these companies because a lot of these companies are gatekeeping access. However, as demand surged, increasingly complex structures like multi-layered SPVs emerged, making it really difficult to determine who was truly backing a company and also on what terms. And there were several high-profile enforcement cases in 2025, including Link2's bankruptcy and the indictment of a manager from Sistante Capital for defrauding investors, really highlighting how opacity can create risk, particularly for less experienced private market investors. However, these incidents do not invalidate SPVs entirely, but they do underscore the need for stronger diligence and safeguards. In 2026, I expect SPVs to face significantly greater scrutiny from both regulators and issuers. To limit unauthorized transfers and regain control of ownership, top startups like Anduril and OpenAI, and these are screenshots taken from their websites directly. These companies are tightening rules around SPV for participation, including limiting which companies are permitted to form SPVs and who may even invest in these vehicles. The burden of diligence will also shift more heavily onto buyers. After all, not all SPVs are created equal, and investors will need to scrutinize these structures more carefully. This includes understanding what information rights they have, if any, what are all the fee layers, and what total are they paying in fees, and whether that's worth it, and whether the SPV can really verify the ownership of the underlying shares, which is the reason why there were so many issues with the companies I mentioned earlier.
So Emily, we have about one more minute. We'll have to go to Q&A.
Okay, sounds good. So looking forward to wrap things up, we really expect a broader set of investors to participate in venture secondaries. We had notable examples of Pinegrove closing its $2.2 billion debut venture secondary fund, and Insight Partners poaching an industry ventures veteran to create its venture secondary strategy. And we expect this to emerge throughout the year as investors capitalize on this rapidly developing market. And dry powder is a great way to look at how much this space has grown. It's grown 2.8 times since 2022, signaling growing appetite. But still relative to primary VC, it's about 3.9% of primary VC dry powder, showing that there's a lot of room for this market to mature. Overall, to conclude, growth in 2026 may not be smooth or linear, but the direction is clear. The market is really moving from proving relevance to becoming embedded infrastructure. And venture secondaries today sit squarely in the middle of their development cycle. And 2026 will test whether the market can operate efficiently, absorb volatility, and really redistribute liquidity beyond a handful of elite names. So thank you for your time, and I am happy to answer any questions you may have.
Thank you so much, Emily. That was great. Lots of good data there and information. So what do you see as the main drivers accelerating the demand and interest in the secondary markets?
So on the buyer side or just like overall?
Yeah, overall.
So on the buyer side, the secondary market is a great way for investors to maintain or add to their allocation. So a lot of times investors are doubling down on existing investments, but also some are trying to get access to these companies that they might not otherwise have been able to access through primary rounds. And also the startups overall are just becoming more comfortable with having a secondary policy and adopting these tender offers so they can attract more employees and more talent into their companies. So a lot of different factors really providing tailwinds for secondary market.
Interesting. Questions for Emily? Go ahead, Bart.
Hey, Emily, do you have any data on the sell side? What proportion is either sort of employee, founder, or early investor?
Well, most of these transactions are between investors. So employees do play like a big part of like the tender offers, for example. But if you're looking at actual like value that's being transacted, it's mainly among investors.
And is that, I don't know if you have the insight on it, is that being done at the company level, or is this sort of fund selling out, one LP selling to another LP at the kind of the fund level?
Yeah, so most of the volume is happening on like the company level. It's easier to underwrite, but there's a lot of fund secondaries happening as well, and I think it is rapidly growing. But there is just like more diligence that needs to happen because you have to re-underwrite every single portfolio company.
Claire.
Thank you. I appreciate the presentation. You had mentioned within this SPV context that there was going to be a greater highlighting a greater need for more scrutiny and safeguards, particularly from regulators and investors, and that there was going to be a bigger shift on the buyer to do more investigation and due diligence. Can you describe any challenges that investor might have in obtaining the information that you were talking about information rights or fees or ownership of the underlying shares?
So, like the reason why I feel like it hasn't happened recently is if an inexperienced investor gets an opportunity to invest in OpenAI, for example, they are probably very excited for that. And then if they aren't really familiar with all the mechanics, then they might not know what questions to ask. And I think that as this becomes like more prevalent, the investors that are interested in like buying these stakes just need to ask more questions to the SPV fund managers, and they should be providing this data if they want to have people invest in their vehicle. So overall, I just think that this conversation needs to like be more regular and more frequent.
All right, Herbert, last question. We gotta go.
Yeah. My question. The second part of it was, do you think that level of scrutiny will cascade down to the secondary space as well?
Level of scrutiny for SPVs, or?
You said that you expect a level of scrutiny to increase with SPVs. Is there another level of scrutiny that will happen with the secondary market as well? And particularly fund manager to fund manager when those transactions happen.
Yeah, so I think the secondary market is, as it matures, there will just be like more questions being asked, and probably one reason why I'm here today is because you're hearing more about it and you want to learn more and understand what goes behind the scenes with this. So I think SPVs are probably the first level of getting more scrutiny because it has a little bit of a bad reputation based on some bad actors. But overall, I think with direct and fund secondaries, they're happening between like experienced investors. So there is less, there's like more experience behind there. So it's a little two different types of investors.
Great. Thank you so much, Emily. This was amazing. And for those watching, we will be posting to the committee webpage under meeting materials if you are interested in looking at Emily's slides. Wonderful. Thank you so very much. Our next speaker, Nigel Dawn, a senior managing director at Evercore. Nigel heads Evercore's private capital advisor and has 20 plus years of experience advising in the secondary market. So thank you so much for joining us today. And we are really interested in learning more about how you see the secondary market and what role LPs, GPs, and continuation funds are increasingly playing in the secondary market.
Terrific. And are you going to pull the presentation up, or should I put it on the screen?
If you can share, that would be great.
I'm sure I can. 1 second. Can you see that?
Yes, there you go.
Perfect. Well, thank you for the invite. I appreciate it. So Nigel Dawn, I run the private capital advisory business at Evercore. And we are a dedicated advisor in the secondary market. We are about a team of 160 people. We executed about $120 billion of secondary business last year, which makes us about 50% of the entire secondary market. So, you know, the comments come from that backdrop, seeing quite a material amount of the transactions. And I've been in the secondary market for about 26 years now. When I started the market, I think it was about 4 billion. It was 225 billion last year. So it has been a great ride. I just want to start with a private markets backdrop. And as you can see on the left, private markets has grown materially, you know, over the last 20 years or so. Institutional contributions to private assets across private equity, private debt, private real estate, private infrastructure have increased multiples. And the secondary market, you will still see, is a relatively tiny part of the overall embedded private assets. So even today, the secondary market turnover is around 1% of private markets, when if we compare that to public markets, it's obviously tiny. Notwithstanding that, the private secondary market has been transformed from a really niche market to an important part of the private markets infrastructure now, as you know, limited partners, institutional investors seek to get liquidity from their investments. At the same time, on the right side, the number of public companies has come down over time, whereas the number of PE-backed companies and private companies has increased materially. And one would expect, we expect this change to continue over time. So much of the value creation for corporates is, you know, taking place in the private markets, not necessarily the public markets. Now, if we double click on the secondary market, and these statistics come from a market report that we issue every year and every half year, and I'm happy to share, obviously. But the market increased materially over time, as you can see. And last year was $226 billion, a material increase over the previous year. And this market has changed over time from one that was driven by institutional limited partners, effectively transacting in their fund interests, to a market that is now balanced, I would say, between limited partners transacting, selling their LP interests in underlying funds, to a market that is driven by general partners who are seeking liquidity in their portfolios, and many of them using continuation vehicles. Continuation vehicles I'll get into in a little bit more detail in a couple of minutes, but effectively ways of creating liquidity for their investments where their investors are demanding cash back, but the GP does not believe it is a correct time to sell the portfolio company in a final exit. So it's creating a liquidity option for the LP in an interim step. The other thing to really note on this page is that the amount of dry powder now in the market, dry powder obviously is capital available to invest in this asset class, which now stands at about $216 billion at the beginning of the year. And in addition to that, so that's what's available right now. And we expect over the next 12 months, secondary investors, those are dedicated pools of capital just to invest in this asset class, will raise another $200 billion or so. Notable in the private markets ecosystem is available capital is around 1 year of transactions. That would be considered, a relatively small amount if we compare that to the venture capital business or the buyout business, where usually you have perhaps 2 to 3 years of available capital available compared to the current year's transaction volume. So that gives you a little bit of background on the growth of the secondary market and the changing composition in terms of the factors and the players who are driving this market. And if I look at the solutions that are available, the big picture, of course, is that this is about getting liquidity for illiquid assets. And obviously in the public market, you just go and you can sell your share immediately. These are markets that have created over time specifically for alternative assets, illiquid assets. So there is a reasonably functioning secondary market. And there are 3 types of ways that liquidity is being generated. And the first one is limited partners selling their portfolios or their individual. And this could be a diversified portfolio of LP interests. And this could be a limited partner, be it an endowment foundation, a public pension, a sovereign wealth fund, that sort of long-term investor in this asset class, selling a portfolio of LP positions, typically to actively manage their portfolio. Sometimes they may be selling older LP interest to recycle capital into new investments that presumably will generate a better return than the ones they're selling. Or it could be rebalancing what they consider to be their core managers they've decided to continue investing with going forward, who they may also do co-investments with, selling out of old positions to generate and recycle capital into new positions, or just sector-specific sales. Sometimes that, for example, an investor got into an asset class or a particular sector, for example, venture capital around 2021. Many investors invested in that asset class for the first time and have not done particularly well. So we see some investors then cycling out of that asset class, maybe into other asset classes where they feel more comfortable. And the final one is what we call a tail end cleanup. And one of the jokes about private markets, it has very, very high barriers to exit, where typically in an industry you would think there's high barriers to entry. Most of private markets investments are executed through 10-year limited partnership structures. And the idea originally is that you would be in and out of your investment within 10 years. The latest data is the average life of a 10-year fund is about 15 years. So often an LP will be left with lots of assets that are very old in the tooth. So they look to sell them into the secondary market so they can recycle that capital into newer investments, which they hope will generate more return. Second big category is GP-led. And the biggest category by far here is continuation vehicles. And continuation vehicles have been around for some time, but have become very, very popular, I would say, in the last 7 or 8 years. And they come in two main flavors. One is a single company continuation vehicle, and that's generally a general partner will have a company in an older fund, and typically it is a high-performing company that has a lot of go-forward potential, and they don't want to sell it given the value creation. So they will want to sell this into a new vehicle they'll continue to manage, give their existing investors the option to continue investing in the company, or have a liquidity option should they wish to take some or all of their return from that investment off the table. That's single company. Multi-company is where a general partner may have, more than one company that they put into a continuation vehicle. Much more flexibility here. They may be minority stakes. They could have companies from multiple funds they run, but generally they're designed to generate liquidity for the underlying limited partners, for their investors, particularly recently at a time of low liquidity in general partner portfolios. And the last two, equity recapitalizations and tender offers, relatively small part of the market. Equity recapitalizations is generally selling a strip of minority interests into a new vehicle to reduce exposure. It could be an outsized exposure from a general partner, which they choose to sell into a vehicle. And finally, and perhaps one of the newest areas, just structured solutions. Think about these as collateralized fund obligations in some fashion as one of the main categories, where either a general partner or a limited partner uses a structured transaction to generate liquidity through the capital markets. So effectively, from a limited partner, using a pool of their assets, selling them into an SPV, and issuing rated debt off the SPV and selling them to institutional debt investors. Other ways are portfolio leverage, or what's called NAV loans, NAV being net asset value, where a limited partner or a general partner will seek to raise funds and liquidity on their portfolio to send capital back to limited partners through a loan. And other preferred equity and joint ventures are a smaller part of the market to generate capital. And just in terms of the last slide, I just wanted to say, an illustrative GP-led continuation fund, selling, you have effectively a legacy fund, which could be an existing fund of GPs managing. There will be one or more assets. Let's just keep it simple. One company, which is typically done very well. It's one of the winners, but it has a lot of future potential. Generally, it may need additional capital, and typically the assets at a point where it will be ready to exit. So typically the GP will be ready to sell the company, and options are IPO, trade sale, a sponsor-to-sponsor transaction where they may be selling it to another private equity fund, or a strategic exit. However, a continuation fund usually is used where the GP believes there's a significant amount of upside, and they wish their investors to be able to continue taking advantage of it. So they create a continuation fund vehicle where new secondary investors will capitalize that continuation fund and provide liquidity for the LPs who are looking to sell. So it's like think about an off-ramp for LPs who are looking to get liquidity on an asset that has got a lot of upside. And if you think in terms of maybe public investing, it's like running your winners effectively. I mean, usually you cut your losers or you run your winners. This is a way of, once you've figured out which is a really great asset, a GP may choose to issue a continuation fund to continue running their winners. And that's really what I had today. I've gone through this a little quickly, given there's some overlap with the previous presenter.
No, that's great. Thank you so much, Nigel. I have a clarifying question. Earlier, you said that there's $216 billion in dry powder, and you thought that there would be another $200 billion, what, over the next year?
Yeah, raised over the next 12 months or so.
And where will that extra $200 billion be coming from? Will there be new investors in the marketplace, or do you think people will just be, where do you think money's coming from?
Yeah, it's usually existing limited partners.
Okay.
And the other part of it is there's a growing part of the wealth management channel, which is investing into alternative assets, which they haven't before. So that is a meaningful part of the market. Also, in terms of private market investors, affiliated insurance companies investing in more private credit and probably private equity. And sometimes I'd say another area that's grown is sovereign wealth funds, which is a part of the market which has with petrodollars and the rest of it become a much more important investing group.
Go ahead, Rose.
Sure, thanks, Marcia. Nigel, would you mind stopping the share to facilitate the discussion over Teams?
Excuse me?
Would you mind stopping the share screen to better facilitate the discussion over Teams? Thank you. I just had a question. What are you seeing in terms of, pricing and valuation discovery, and is it different? You put up a variety of situations here. Is it different in each of those secondary contexts, or is there really an overarching of, as you say, these are existing LPs, they already have the availability to see that data? I'd be interested to understand how that valuation discovery is occurring.
Yeah, I mean, typically our role is to execute a competitive auction process for each of the execution methods that I showed. And so, we will, so in some cases we will go out to literally hundreds of investors to get bids. And, there's, typically the underlying information will be shared with the new investors. They may, an investor bidding on a certain situation could be an existing investor in that asset. So, yeah, I mean, typically, so price discovery is usually through a competitive auction process.
So a competitive auction process primarily with sophisticated players under NDA?
Yes, like usually institutional investors, often dedicated secondary funds, so pools of capital that have been put together, that are groups that are investing over many, many years in these situations.
And so are you, and apologies if this was part of what you were talking about, but it sounds like you're not at Evercore, not necessarily involved in the tender offers with the employees selling, or are you?
No, we don't really, we're not active in that part of the market.
Okay, all right, thank you.
And Nigel, what is like too small to get onto the secondary markets? Is there a place where you're just seeing like, no, like that's just too small of a fund or too small of a company, that it's all these bigger guys that are really taking up the secondary markets?
There's really a role for all shapes and sizes in the market. Some very small secondary buyers, but obviously that, it tends to be the top 5 investors is probably like 50% of the market. So it's like, like the rest of private markets, there's a move to scale. Secondary market is no longer different. But we certainly, we've transacted in the hundreds of thousands. I think when it gets smaller than that, it tends to be more challenging.
And I'm curious, like, what do you foresee the secondary markets, how impacting IPOs and the public markets in general?
Could you just repeat the question? Sorry.
Well, how do you see the secondary markets impacting companies who will IPO or could IPO? And then, how are we going to see the public markets in the future if these secondary markets are going to keep growing so much?
Well, I think that it feels like there's still a robust public market now, and there'll be certainly a role because the size of the largest companies that were way too big for the secondary market. So this is more, if you think about mid-market firms, smaller firms. But some of the data we saw on the largest private raises, I mean, they're just massive. So our sense is you need a robust public market, a robust private market. But the size of the private market, I think, is likely to grow further, just to keep pace with the growth of the underlying growth in private markets. Generally, the secondary market has to continue to grow. So I'm not sure that there's going to be a direct, you need both of them for different reasons.
Mm-hmm. And you think that the smaller companies, smaller funds will actually participate more in the secondary markets so that maybe they can grow a little bit more and then they could IPO? Is that possible?
I think it's possible, more like on the direct side of the market, what the previous speaker was talking about, direct secondaries of that nature, and that it's probably going to be more relevant there.
Mm-hmm. Rose?
Yeah, follow-up question on your last slide around continuation funds. Are you seeing any trends where, obviously there is the rise in continuation funds, we're changing the owners of assets. That's on the rise. Are we also seeing, the rise of there's more assets to change hands, or are we just turning over, is the recycling of the capital that owns the assets versus, adding new assets to be owned to the mix?
Well, I think, this is more the, recycling assets and extending their life in a sense that, a private equity hold period, in terms of the period of time a GP would expect to hold an asset, was probably historically about 4 years. Now, in the current environment, that's been extended to probably 6 to 7, given the, change in the debt markets, the change in the public markets, change in multiples. So it's taken longer to achieve a business plan. So as a result of that, there's pressure, for limited partners who want their capital back faster, to drive the growth in the secondary market.
Yeah, I guess
Herbert.
Sorry, Marcia, let me just ask that a separate way. Like, so when that LP or that GP is getting liquidity sooner, right? Because yes, it used to be 4, 6 years, now 8, 12 years, depending on the data set. Do you have a sense of, are they recycling that capital into a net new investment, or is that capital getting recycled into a secondary, right? Like,
the short answer is I don't know.
Okay.
But
Thank you.
the likely answer is, because each individual investor is going to decide what they want to do. But I think it's fair to say that some will get recycled into brand new investments, into new vintages for managers they've always supported. Some could well be recycled into secondary funds. So I think it could go both ways and across different asset classes.
All right, Herbert, last question.
And Nigel, when you think of secondaries, which verticals you see as most promising or prime for acceleration?
I think that we see a lot, not surprisingly, in private credit, because the holding periods for private credit portfolios have been extended, given the underlying companies are being held for longer and there's refinancing events. And capital is being formed with the right cost of capital now to buy those positions. In other words, capital that has a debt-like return expectation, not an equity-like. So I think that is interesting. Certainly, private secondary infrastructure, in the same way as probably the bright spot in fundraising last year in private markets was infrastructure. So that is a growing asset class. It's a growing part of the secondary market. Probably 10% of the secondary market is definitely growing. Sorry?
When you say infrastructure, you're talking roads and that type of stuff?
I'm
what do you mean
talking
by infrastructure?
From digital infrastructure to toll roads.
Great. Thank you so much, Nigel, for your presentation today and coming here and sharing your knowledge with us. We really appreciate it.
Happy to. Thank you very much.
And our next speaker this afternoon is Billy Duvall, Special Counsel at Cooley LLP. Billy's practice focuses on emerging companies and venture capital, and he has experience representing issuers companies as they navigate the expansion of the secondary market, including insight on company tender offers. So, Billy, thanks for being here today.
Thank you very much for having me. Can everyone see the slides?
We can. Perfect.
Awesome. So I work with a lot of our late stage private companies, and that means helping them prepare for IPOs or exits, as well as handling the crossover financings and the secondary liquidity transactions for those companies. A few years ago, unsurprisingly, that meant a lot more IPO preparation, and recently it's meant a lot more secondary liquidity type transactions. On this slide on the right, you're going to see a graph that several other speakers have already showed you in a few different forms. And so I won't spend a lot of time, but just highlight that we saw, a historical high of IPO volume in 2021, followed by a steep drop off and a slow recovery over the next 3 years. And while we have been seeing the IPO market start to reopen, it has remained closed for a lot of companies, and we have not returned to even the pre-2021 peaks. During that closed window, many companies have sought alternative sources of liquidity, including secondary liquidity transactions. Now, the data is a little bit more fragmented here, and Emily gave you a lot of great cuts on this already. One of the platforms that handles a lot of these tender offer style secondary transactions is NASDAQ Private Market. This graph on the left is just showing their deal volume over the same time period. And you'll see it has a similar shape to the IPO market. But two things to call out are that the trough in 2022 was not nearly as severe, and the recovery has been much faster, with the 2025 deal volume actually exceeding the 2021 peak in terms of dollars that passed through that platform. So I'd like to talk a little bit about what's driving these secondaries, because it can be any of the stakeholders at the private company level that are pushing for these transactions. From the founder or key employee perspective, they can be looking to get liquidity and take some money off the table while preserving upside potential on remaining holdings. This is very common if the stock is deeply in the money, so it doesn't mean that a founder has to sell a significant portion of their ownership to take some cash off the table, and they still maintain control. From the company perspective, while it might seem counterintuitive to do a deal that is costly, that doesn't result in much cash to the company, it is non-dilutive, and it can help clean up the cap table by swapping out small holders with institutional investors who can support a crossover or an IPO transaction down the line. You've heard a consistent theme about companies staying private longer, and this has resulted in many of these VC funds holding those illiquid assets as they near the end of that fund lifecycle, that original 10 years that Nigel was just talking about here. And this is a great way for them to actually get some liquidity and exit. I am also seeing a lot of these deals where newer versions or newer vintages of the funds come in, allowing LPs to choose whether they are selling and getting a return or rolling into the newer vintage as part of that tender offer. A sale today can actually result in a higher IRR, internal rate of return, than an IPO in several years, depending on the valuation that they originally bought and the holding period. And lastly, for those later stage or new investors that actually have the dry powder and capital available for putting new money in, it lets them really double down on big bets, because they're coming in what isn't necessarily a priced round. And so they can negotiate a discount and lock in a gain for that eventual IPO or exit down the line. These are a few of the most common deal structures that we see in these types of secondary transactions. Each of these could either be one-off secondaries or secondary structured as a tender offer, so it's not exclusive to that type. Redemption is where the company is redeeming and repurchasing stock directly from investors and using existing cash reserves. This is common for late stage companies that are generating excess cash and are looking for somehow to deploy it beyond just growth. It can also be funded through venture debt or other sources of cash. One very common source of cash is the direct investment followed by redemption. This is where investors are purchasing stock directly from the company. And one of the uses of proceeds of that financing round is then to redeem stock from the company in order to reduce the dilution impact of that financing. This happens a lot when the offering is oversubscribed and the company or its existing stockholders are not willing to take the extra dilution of upsizing the round. And so they instead utilize that cash to buy out investors and even key employees who are looking for some liquidity. The next structure we see a lot is a secondary sale where investors just buy stock directly from selling stockholders and then hold it. This can either be a standalone transaction or in connection with a direct investment into the company that is a priced round. The most common structure I am seeing these days is this combined transaction, and I believe it's because the primary investment round sets the reference price for the secondary transaction, where otherwise you might have quite a bit of back and forth trying to figure out how to price that secondary. And the last structure is just really a variation of that combined transaction, where instead of the investors holding the common stock and preferred stock that they are purchasing from the selling stockholders, they exchange that stock with the company issuing them new preferred stock. So they end up holding just a single class of preferred from both their direct investment and their secondary investment that has all of the economic and control protections they negotiated as part of the primary financing round. There are a number of unique challenges in private secondaries. Structurally, it can be quite difficult to determine if a transaction needs to be a tender offer or not. The Wellman test and the 8-factor analysis is subjective rather than objective, and several of those criteria are more applicable in the public company context than the private company context. As you heard from Emily, the typical venture-backed company is going to have a right of first refusal and co-sale agreement, which has contractual rights, which would mean that a founder trying to sell their shares needs to give all preferred stockholders a right to either purchase those shares or sell along those shares at the same price. That can transform a simple one-off secondary transaction into a transaction where we need to go out to a large number of individuals if the company is complying with those rights rather than seeking a waiver, and turn it into a type of deal where we need tender offer rules in order to comply with securities laws. That can take a small transaction that made sense and make it not economically feasible because of the increased legal and compliance risk of doing a tender offer deal. You know, these are not companies that are 34 Act reporting companies, and they are not as familiar with preparing the types of disclosure that you would need to prepare an offering document that's compliant with tender offer rules in many instances. And so it does significantly increase their deal costs if they're going to have to go that route. From a control perspective, the market standard for many of these companies is that preferred stock does not have the same level of transfer restrictions that common stock has. You heard a lot about Emily saying the most common type of transaction is investor to investor direct trades, and this is the preferred stock to preferred stock. As long as this transaction is being done in a securities law compliant manner, and it's not one of those companies that has significant leverage like OpenAI that has put transfer restrictions on all stock, a company really can't block these deals. And so these types of deals can be happening simultaneously, and the investors on both sides may have very little visibility into all of the different transactions involving the company stock that are occurring simultaneously among different investors. And last, just from a disclosure perspective, if we were doing a broad tender where all company stockholders are eligible to sell, that would typically mean we have employees, former employees, institutional investors, founders, and board members, all potentially able to sell in the deal. That's a broad spectrum of investor sophistication that we're dealing with, as well as some significant differences in terms of access to current company information and information on the company's plans and future prospects. And if there's a third-party purchaser who's coming in and making this bid, they have likely engaged in a fairly robust diligence process in order to set the price and get comfortable, and may have had access to management and forecasts. And so we need to prepare a disclosure document that provides all material information to all parties and puts them on information parity. And while that's old hat for our public 34 Act reporting companies, it is a very new exercise for most private companies that haven't done it before. And particularly when we're balancing against confidential and commercially sensitive information, it can be a real challenge for them. And so with that, I'd like to open it up for questions.
Thank you so much, Billy, for that presentation. As far as the control thing, can you talk more about that? Like, I was under the impression that, or maybe I should ask, when can companies like not have any idea that shares are being, traded between investors, like, and they don't even know it? Like, what?
Yeah. So the company is going to know. It's the investors who won't know who else is doing it, right? So what would typically happen is that there's going to be a 33 Act legend on the shares that says you cannot trade these shares unless there's a valid Securities Act exemption. There may be an additional legend on common stock, for example, that says you need the company's permission to trade these shares, and there's a right of first refusal and co-sale on these same shares. With the preferred stock, typically, if there is an opinion of counsel that says a securities exemption is available, one investor can sell those shares to another investor and just give the company a notice that says change in your books and records that this investor owns these shares. So the company sees it, but as an investor who is potentially soliciting or saying, I'd like to purchase shares, they might not know that there are several other investors also soliciting the same employees and key holders for their shares at the same time, possibly at the same or different prices.
I was going to say, wouldn't there sometimes be different prices then? Yeah.
There are, and this is where it can be tough to make the determination, and we'll sometimes have to tell investors, we think you should pause and think about whether this needs to be restructured as a tender offer, because we're seeing a lot of solicitations in a short time period.
Mm-hmm. Questions for Billy? Go ahead, Bart.
Just in general, when you're talking with companies, how are they weighing the pros and cons of a secondary offer versus an IPO? Like, can you provide a little bit of insight as to what that decision framework looks like?
Yeah, I have never heard them be talking about secondaries where an IPO is truly on the table, is the sort of the starting point. It's usually a question of our IPO timeline has lengthened. Is it worth doing a secondary in the interim? And again, it's who is driving for it. So one of the most common drivers of a secondary is receipt of investors who are looking to double down on their position, right? They've heard the IPO may be happening in a few years, or it's a ways out, and they are looking to lock in some gain today because they also know that some of the early investors are ready to sell and take a 10x return today rather than waiting for a 12x in 2 years. And so these are sort of many of the big drivers. And I do expect that it might generate some pressure down the line of if an investor came in a secondary expecting an IPO in 2 years and that doesn't materialize, are they going to start pushing these companies to go public? And I think a real key question there is, are they continuing to see primary financing valuation step-ups along the line that gives them confidence that the company is building towards that eventual exit?
And I guess a quick follow-up there, like, are you seeing differentials in sort of the valuation metrics? So, again, if you've got the sellers, I don't know how much they're actually driving the conversation, but are they perceiving a difference between the valuations that they get in the public markets or in the private secondaries?
it's not apples to apples when you're talking public versus private. Where I'm actually thinking about valuations is priced rounds versus secondaries. And so there's a lot of pressure on, are you pricing at the most recent venture-backed financing round? Are you pricing at a percentage discount, or are you pricing even at a premium, which I'm seeing in Sun? And so typically the conversations I've been part of have been not about public versus private valuations. It's been price round versus secondary, and actually how much of a discount are you doing for different classes? As you approach an IPO, the value of the common stock should be collapsing with the preferred stock, since it's all going to be converting. And so the further out you are, the more you might see these secondaries structured with different prices for common stock and different classes of preferred stock, since it would have those downside protections if the price were to decrease.
That's interesting. Rose?
I guess a couple questions here. So first, just to clarify something in your last answer. So these premiums, you're seeing those on the direct, right? So the funds going into the issuers themselves are the ones that are being, issued at a premium. Is that correct?
I've seen it both. So I have seen, if the primary financing was a $1 billion valuation, I've seen the secondary conducted at the same time at, a 20% discount, and I have seen it conducted at a premium as well. So it most common is the same valuation, but I have seen it in both other ways as well.
I mean, equally on the sell side and on the secondary, being the premium or being at a 20% discount, or is it
Discount
weighted
is
one
most
way or
common.
the?
Yeah, so it's the most common is the same price, and then discount is by far the most usual. Usually, if it's a premium, the financing has not been simultaneous. You're looking back 5 months from the most recent raise, and you're saying we are doing a premium to our last raise, but we are not raising fresh capital simultaneous with this secondary.
And when the issuers are looking at the situation that you've talked about, the investor wanting to double down, or an new investor wanting to get more points on the cap table than maybe the round allowed, what are you seeing from the market in choosing to have that be a secondary, which is going to liquidity of investors as opposed to the business itself, getting that capital through a direct raise?
Yeah, I mean, the biggest thing is that the companies that are doing these are the ones that don't need the cash, right? If they need the cash, they're going to be doing primary rounds of financing. And so the secondaries are for ones who have less need for this capital, usually, in what I'm seeing. And if it's a company sponsored and assisted tender offer, typically there's got to be a rationale for the company of why it really makes sense. It can be something along the lines of you've got a lot of former employees that you're trying to clean up off the cap table. You've got insiders who are looking to sell. You've got early investors on the cap table who you're looking to help get some liquidity to. So usually there's got to be a reason for the company to really assist with this type of deal. They wouldn't take the time and expense and effort to do it if it didn't make sense for kind of one of the reasons that I was laying out earlier.
So let me open up the aperture just a little bit then. So if we're having more of this capital go to a combination direct secondary, primarily secondary, and the issuer doesn't necessarily, need the funds, are you seeing this capital being recycled into net new investments, right? Are you seeing that there's smaller companies that are unable to raise because the institutional VC is going to double or triple down on one of their larger investments?
I mean, it's going to be anecdotal for me, but I can tell you that I have angel investors writing checks in some of my companies the week after they're getting secondary liquidity on my other companies. And so, for many of these smaller investors, we are seeing it recycled and going right back in. Now, on the key holder and officer side of things, that is I'm looking to put a pool on my house, in many type of those. It's the first real liquidity for some of these founders. And while they might have large gains on paper, they have no cash. And so for them, it's a de-risking, and they're not taking that money and writing a check somewhere else into a new company.
Any more questions for Billy? Yeah. Billy, thank you so much for being here today and sharing your knowledge with us and giving us your presentation.
Thank you.
Great. All right, we will now turn it over to our own discussion. I would just first like to hear from any of the committee members who are dealing with secondaries, firsthand. What are some of the most recent stories, things that you're seeing, especially if you're a fund manager or work with startups all the time?
I can kick it off, and others can sort of chime in. I think the area so for context, I'm particularly working with early stage, to be sort of VC backed, so that kind of like Series C to Series B kind of stage, and the secondary scenario that I see more often than not is what Billy was talking about, where it's sort of a combined primary and secondary, where you have key holders and then maybe early investors, maybe some other employees that are getting liquidity opportunity to sell some of their shares. The most common transaction structure that I see is with that exchange on the back end, so that the investors wind up with preferred stock, but there's a variety in the market.
Yeah, Erica?
Yeah, I'm seeing a lot of sort of institutional secondary vehicles being spun up in the market, very specifically looking to go out and buy strategic assets out of GP portfolios. So it's actually kind of a nice option to have. I think it gets a little bit complicated because, as we've discussed here, it's not as easy as, hey, somebody wants to buy this for me, I'll sell it. It's kind of a delicate situation, with making sure that the founders are on board and you've sort of complied with all of the other co-sale and right of first refusal requirements. But I think it is really helpful to GPs and LPs to, have an additional source of liquidity because companies are staying private far longer than we ever expected. But I think the other thing, that's been covered a little bit over the course of the day is we're seeing a lot of activity happen in secondary markets and, some of these other things that we talked about, even just investment overall. But we can't be distracted from the fact that the vast majority of the transactions are happening both within a very small number of names and, the AI sector, some very specific sectors that are hot right now. So I don't think it's, widely available options for the majority of, just the various types of companies that drive the US economy. But maybe, I think as more people use it and become familiarized with these options, they could be more and more useful going forward.
Mm-hmm. Rose?
Yeah, building on what Erica just said, there was an interesting comment earlier around the destigmatizing secondaries, because as a pathway and regulatory pathway, including under the SEC's rules, these aren't new, right? These have existed. I have handled secondary transactions for the last 25 years. Absolutely, that volume has picked up in the last handful of years. You're now seeing dedicated funds and structures. So I wonder if, as it becomes, seen as a viable tool to recycle capital, right? Is it another third stool of the exit of, the IPO or the M&A? Do we now have a third exit stool? of secondaries that might trickle down to smaller companies beyond the absolutely huge numbers that were just put in front of us as to who's taking all this capital. I would be interested to see and maybe explore if there's a way to further open up that third leg of the stool for smaller companies to help some of that capital, trickle down and recycle. Because that's, my concern listening to this as this capital is getting put into secondaries for liquidity of these large companies. And then maybe that investor is just doubling down on another bet in that same sector, as opposed to moving out of that sector or smaller companies. I'm not sure we're really feeding the engine. The other thing is I less often see the tender offers with the information parity. I know we heard this in some of the remarks, and this has been said publicly by some of the commissioners, but I more see like what's more opaque in terms of that information asymmetry and that price discovery. I mean, it seems every week we're reading a news story about somebody locked in a gain on an undisclosed price, and then maybe there was a later round and people got it at a discount. And so it just seems like people are coming to the table with all sorts of different information assumptions, especially in the direct secondary market. The other thing that we heard in the remarks this morning, and it was somewhat touched upon by our presenters, is you're seeing structures in the market to get around the rights of first refusal and transfer restrictions by putting up SPVs, special purpose vehicles, that are, for lack of a better word, monkeying as to who is the beneficial or indirect owner of the revenue coming out of that. And are you actually changing the beneficial owner or not under the SEC's current rules? Because people are clamoring to get into these secondaries. And again, I just see it's opaque, funneling capital to this top end of these super high valuation companies that may or may not go public. And I'm not sure we have an answer yet as to how that's impacting the capital raise, the direct raise down here for smaller companies that continue to struggle.
Yeah, we heard a lot today about the size of these deals. I mean, trying to get a little bit of context about like how small is too small and things like that. So could we get back to actually helping some of these smaller businesses and some of the startups that are, coming up, not necessarily all the way at the top, but it does seem like there's a lot of capital in the secondaries at the much later stages. So what would we think about as a committee that we can help the commission think about what we're seeing, the things we're learning? I mean, we haven't seen secondary markets like this really ever. And the IPO markets, so one of the slides that we saw was, flat or even declining a little bit, and the secondaries are going up. So what are some of the things that as a committee we could discuss that would be helpful? Rose.
I thought there was interesting commentary about, yes, tender offer rules are written for public companies. They can be tricky to apply in the private market context. Would you facilitate, more information parity if you had tender offer rules designed for secondary markets? I think that could be something that would be interesting, and then you may actually see more recycling of capital at smaller companies because it is a cost burden, right? You're not going to see tender offers for widespread liquidity to recycle capital at mid-market to small companies. I mean, it goes kind of to the cost burden of, Reg A that we talked about. It's not all the way up there to an IPO, but it's not nothing. So if you had scaled rules for that, that could be one, one potential. I think that would, benefit the overall, market discovery and well as potentially recycling the capital.
Mm-hmm. And what about as we talk about the companies that will or could IPO? We've heard from Chairman Atkins quite a bit on we want to make IPOs great again. How do we do that? We need the costs to come down, or there needs to be, some easier routes for the companies that are smaller. Again, we heard a lot today about the bigger companies and what they're doing to get money and to gain capital, but we didn't hear as much about smaller companies and what they can do. Anyone, feel free to chime in.
Marsha, I don't know how you make IP and without really giving some strong consideration to the cost and regulatory burdens, the reporting and everything. I just, if I were in a position having a conversation with someone considering an IPO, I would steer them away, without fail all the time.
Mm-hmm.
And maybe this is the new normal.
Maybe. I don't know the answer to that. Go ahead, Rose.
I was just gonna say, and maybe that new normal is a bifurcation, right? Because I mean, a lot of these companies that we just heard about that don't necessarily need the cash, they're doing combination of direct raises as well as secondaries. They can cover the cost burden of going public, but they're able to give liquidity to people that are end of life on their funds or the people that need to put the pool in their house or, often in the Bay Area, just buy a house and cover the mortgage. So I think that cost burden is more felt by the small businesses where maybe these robust secondaries aren't even an option to give the liquidity, and they would benefit from being able to have a pathway to a public market to then, right, give liquidity. I mean, it's interesting if you want to think about the cost and the disclosure burden. We have rules that scale that already for the size of the company. So I don't know if you reduce those, if you're going to impact the money going to this one sector, but I think maybe you could recreate that exit pathway for the smaller public companies. And so that's the bifurcation I see, Herbert, right? Like we would, and we should definitely look at it, right? Because that's going to focus over here on these smaller companies, right? Which would be the smaller public companies. But I don't necessarily know that it's going to change this sector continuing to take, what was the number, like 84% or something like that.
Yeah, Rose, I'll just add a footnote to that. All of our active investments, what I've communicated to the founders is that once we reach a certain ARR, I'm shopping my position in the secondary market. And if they want to go IPO, they're going to do that without me. I don't want to be along for that ride. I would rather, exit my position and use the capital to reinvest.
And Herbert, are you seeing that there's that you're able to do that you're able to go and shop in the secondary market in order to get out of your position?
Marsha, that's TBD.
Okay, got it. Go ahead.
I would say I do think that sort of raises a thread that we've seen a couple times, because one of the comments that was made throughout was funds have longer exit periods. Again, a 10-year fund is now 15 years. I think that has to have a meaningful impact on the cash that is available for new companies that are coming through. So to the extent that we could get money recycled, we can get funds some form of liquidity, presumably you're going to see a lot of that cash get freed up to invest in the next generation of companies. It's hard for me to believe that there is not a relationship between going public for those folks seeking liquidity and the robustness of the secondary markets right now that are keeping companies out of the public markets further. But that's probably a topic worth more exploration.
I thought somebody else had their hand up now. Just what Rose was talking about earlier about, what we've been seeing over the last, especially 4 years, after from 2022, when we started to see interest rates go up and the capital started to dry up a little bit. At least what I'm seeing at the angel level is that there just is not very much M&A activity, and most of the times that we would get liquidity was from an M&A transaction. To Herbert's point, we didn't really expect a lot of our companies, the angel level, to go public. So having this secondary option is interesting, but I think, again, we're talking about a lot of very big companies and not necessarily. Here we are the Small Business Capital Formation Advisory Committee, and we're, these are a lot of the very big companies that we're talking about. Love to hear from some other committee members. George, what are you seeing out there?
Well, just something I guess I'm thinking about from an operator's seat is when Jenny shared her report, and I think Herb called out this point that there was something like, what was it, 60% of business owners are seeking capital, that smart money. They're seeking helpful money onto their cap table, right? And as someone who has raised money in several rounds, we try to be really thoughtful about what capital we're bringing onto our cap table. We've not been in a position where we've had a secondary market transaction, and I recognize that there's some complexity and some protection as an operator about how a fund could sell their position in Honeycomb, but it's just something I think there's a flip side to this as well. Like, startups are intentional, good startups are intentional about who they're bringing onto their cap table, and this idea that people can just swap in and out of the cap table without the business having any say in the matter, that's something that makes me a little nervous.
Yeah, I haven't seen that in my personal experience. Anyone else? Wendy or Jennifer?
So only Marcia, I had the same thought as you, that that presentation didn't, let me say it a different way. Atkins has not only said it, Commissioner Atkins not only said it this morning, but he said it in a number of speeches about make IPOs great again. And I take, I'm thinking about what Bart said, or no, Herbert said about maybe this is the new normal. And I don't know that I don't know that I accept that as a trend. So, I don't know that I want to recommend something that would dead our growth of an IPO for smaller businesses.
Mm-hmm. I think in a lot of cases, the public markets, they do bring, information symmetry, whereas like we said today, the secondary markets could be all over the place. Same with price. But I still think it's probably an important thing to be looking at, that how do we help smaller companies be able to do that?
Well, I think the pricing is what's really challenging for those companies that want to step it on up. I mean, that's what we've heard from all of our clients, that they're just seeking other alternatives because of the pricing. So if the commitment by the SEC at least is to make it more palatable, easier for companies to do it, we might see a turnaround, and maybe we could think about what that might mean or what that might look like.
Marsha, can I just ask Wendy a follow-up? Sure.
Yeah.
Wendy, saying that the new normal, you don't accept the new normal as secondaries as a path, where we should lean more into Chair Atkins' position of making IPOs great again. Is that what I'm hearing? Just for clarification.
I think we should entertain it. I can't make a future that doesn't exist, but I think I don't want to promote a future that continues to see reduction in IPOs.
So would that be a topic maybe for our next meeting to get some speakers around that?
Yeah, that would be great, Marsha, because I think what I've heard is a lot of those providers, whether it's the attorneys or the accountants or the smaller investment banks, and I know some people on this call have experience, have tilted in other directions because there just hasn't been the appetite.
Mm-hmm.
I mean, I would specifically like to hear from folks with, small cap offering experience and the feedback that they're getting. Because I think an illuminating part of this discussion, right? I mean, we can see it in the markets, we can see it in the news cycle, but to have 3 speakers back to back show us where the capital is going right now to very large cash heavy companies that don't actually need the cash. They are not the ones that are feeling this burden, which is why I think maybe it's not a new normal across the entire market, right? But I do think there is a bifurcation happening, and I would need to think more about, are there any levers to undo that bifurcation, or do we need to continue to focus on the small cap, how to make that pathway to, liquidity, however that liquidity looks, because the liquidity, in theory, we believe there's this flywheel, this liquidate, this recycling of capital. And knowing, I think there's always been this segment of the market, and now it's more just very obvious that is staying private and accumulating capital in the private markets. And I mean, my theory is that we have seen this ever since, the Job Act increased the number of people you can have on your cap table before you have to have public disclosure. Right. And I mean, that's where we are.
Yeah, I agree with you, Rose. We did hear quite a bit today about these bigger companies, and if they need capital, they either just go out and raise, or they have a tender offer so that their employees can get liquidity. I mean, there's a lot of things that are happening with the bigger companies, but what are the smaller companies doing, and how can we help them not feel so small? Other things people would want to hear about at the next meeting?
I'll just add, I think we talked a lot about equity, obviously, but one of the speakers, Nigel, was talking about how actually a really significant portion of what he's talking about is private credit in the debt side of the house as well. So I know we're talking a lot about the equity markets, but the bond markets I think are also interesting, and just there's other forms of capital access in public markets, and I think broadening that conversation would be helpful.
That's really great, George. You've personally expanded my view on a lot of things just because of everything you've done with Honeycomb and thinking about, debt in a different way. I know a lot of founders have thought of it as, oh, it's scary. But, the things that you're doing to really help companies see that there's a pathway, depending on the type of company, it really, I think we have to keep our minds open, right? Right. Anyone else? Okay, well, I appreciate everybody hanging in there with us on this very long virtual call, but thank you for being here and for the pivot from yesterday due to the weather. And we will have our next meeting on April 28th, 2026. We will have another meeting on July 1st and also on October 7th. So please mark your calendars. So I move to adjourn the meeting. Thank you all for coming.